You're talking about Impractical Jokers?
No, I'm never ever
Oh,
talking about Impractical Jokers.
they have a whole thing where they got to convince someone to go up to somebody else and say, "Hey, doesn't that cloud look like a supermarket where the onion's on sale and there's a long line at the cashier store?" And the person's like, "Huh?" They're like,
That's
"Yeah, yeah, see
good.
over there, like there's
That's
the onion."
clever. I feel like that's clever. That's good. I like that.
They
What
have
happened
just
with this guy that left? Didn't one of the main guys leave?
wow. Joe
What?
will not be returning for future seasons. He was the best one of them all.
Exactly, dude. He's gonna go, dude. He is leaving NSYNC and he's starting a solo act.
I saw NSYNC live. I never saw Destiny's Child live. I mean, that was my music, the 90s.
How was NSYNC live?
So I went to a concert in New Jersey with a friend of mine from college, and we both liked a lot of kind of dancey music. And it was sort of like a conglomeration of all the top dance artists at the time. And so remember Aqua Barbie Girl?
Yeah, no, you're trip down
So,
memory lane here, buddy.
so we didn't know exactly who would be there, otherwise, other than they said it's going to be all the top artists. So we showed up, and Sync comes out as one of the acts. And no joke, I thought I'd go deaf after that. Because it was probably 75% girls and 25% guys. And the girls were screaming so loud. I was like, man, like if they keep going on like this, I will literally lose my ear sight, lose my ear, my sound.
There's nothing more Brett than going to a concert and saying it's too loud.
I don't want to lose my ability here. That's awful.
Those hairs don't grow back, man. Those hairs
Okay.
don't grow back.
I got a DND and 10 o'clock.
Oh, Dungeons and Dragons, like in Stranger Things. What a perfectly timed
Is
reference.
Stranger Things for like teens? Is Stranger Things for adults too?
Brett,
But okay, I thought it was.
go, dude, just go to a concert and complain that it's loud. All right. Let's get this thing going.
Wow. Don't judge.
All right, man.
When we're 75 and I'm talking, you're like, huh? What? What do you say? And I'll be like, yeah, let's see what happens. Welcome to another episode of TYC, Talk Your Chart, episode 18. So today, Marcos, we're going to start back to the days of bell bottoms, the days of, everything.
Get in the Wayback Machine. Get in the Wayback Machine. Nice.
Actually was looking back what happened in this period of time. Roe versus Wade came out. I was looking, the speed limit changed to 55 miles an hour to conserve gas. We had a secretariat won the Triple Crown. So we are talking about the 73-74 2-year debacle that was the stock market.
Okay, so everyone thinks 70s the thing, inflation, right? Like that's what everyone talks about when you think of what was on everyone's mind. One of the best things you shared to me was what Steve told you was really on everybody's mind in that time. Remember that?
Yeah, I mean, I went to the guru in the firm who had been around at that time and who was a history major, Steve Foldis, and said, hey, how does this period of time now where we have inflation, where we have the Fed raising interest rates, how does that compare to what's happening now? We have, Ukraine, all this wars out there. And he said, honestly, there's some similarities with Watergate, with the Vietnam War, with high gas prices and all of that. And he said, literally, like it was today, where every day without Ukraine, back then, every day was about Nixon and what was going to happen to his administration.
Yeah.
Well, you mentioned last time a stat, I think that the entire 1970s, we had negative real returns, which is return minus inflation for stocks and bonds.
Yeah, we did.
And so most of this stems from this chart that I'm showing here, that is from early 1973, January to the end of 1974, where the stock market was down over 40-some%. And I think what's interesting about that, and this is a period of time where the Fed raised rates, I believe it was 25 times over the course of early 73 to early 74.
That's so many raises. This is 73 to 74?
Right.
Okay.
And I believe that the highest rate it ever got to was about 13% was the highest it ever got to, the Fed's interest rate. So this is a time where your mortgages were going to be double digits. You were getting double digit rates on CDs and treasuries. Like everything was just no end in sight to what was going on. And often I know that I think the last few sort of drops we've had in the market, we've had a really big bounce back, right? We talked about COVID was a period of time when the market dropped 20 some percent, 30%, and then came back within 3 months.
Yeah.
End of 2018, we had a 20% decline in the fourth quarter. And by March, we had made that back up. But 73, 74 is very different. And here we had this giant decline over that period of time. But there were lots of interspersing rallies during that period of time.
That was a classic, you sell the bounce, you don't buy the dip.
Well, and there were lots of bounces. So interestingly enough, I was reading during that period of time, you had two 10% rallies, you had two 8% rallies, and two 7% rallies. During this time, where at the end of all those rallies, you were still down 42%.
Yeah, that's unpleasant.
So I know we talk to a lot of clients, we hear often they say, I'm waiting for the trend. I'm waiting for things to improve, or I'm waiting for things to bottom out before eventually buying. Here is a point where you had lots of bottoms. You had lots of quote trends where things got better for a while and then just got worse again after that. So I think it's dangerous.
That's dangerous. This goes back to last episode when we talked about how you avoid lost decades and lost periods of time like that, where it's the boring answer of diversification. And also, I think the only way to really weather that stuff, because man, imagine investing through that period of time, or even the tech bubble, which was 3 years of negative returns in the S&P. That is going to test your patience a ton. Right. I think that's where you really need to make sure you have a proper timeline to really make sure that you can just put the chart book away, stop looking, let your advisor look for you, and go focus on something that's more productive. Because I couldn't imagine having to go through that and the frustrations with that. And I really feel the only proper way to get through that is making sure your timeline is properly determined to be longer than 5 years. Right. So you can give yourself the mental runway, because that's a slog.
Oh, I tell clients all the time or I see with our clients, those that have hobbies, those that have jobs, are far less impacted than those that are watching CNBC every single day. And I started my career back in 2000. So that was my first experience. And I thought I'd lose my job in the first couple of years because the market was getting tanked so badly during that period of time.
That's interesting. I forgot you started then. Jeez.
It was tough, but we also don't have the Fed to come to our rescue during this period of time, right? It's not as if next month
big difference, huge.
The Fed's going to lower rates, and next thing you know, the market's going to rally because we got this cheap money again.
Yeah, exactly. Yeah, go focus on a hobby if the market does that. Just hopefully your hobby isn't trading NFTs and stuff like that, because no liquidity to prop up your NFTs at the moment.
But ultimately, this is a big positive for savers. Right. You're going to have it. You're going to speak on this a little bit when we talk about interest rates on fixed income, but this should help with people who have cash, people who have bonds, people who have CDs, the savers. Right. If you have a lot of debt out there, it's probably not a great thing for you because your mortgage rate's higher, your credit cards are higher, margin interest is higher. But for those that are savers, you want this. You've been looking forward to this for decades now.
I know. Bro, so what your chart is showing just the S&P's performance over that period of time?
Right. And you can see that this is not just like a V shape where it just goes straight down and then goes straight up. You have all these little jagged pieces in there that when you look at it during that period of time, they look pretty severe. But when you step back over a long period of time, you can barely see the 70s if you look at to like a 40-year chart.
Yeah, that's an unpleasant thing to go through. And then to your point, to just put it together, the decade, right? So the 70s, stocks were up 5.9%, right? So 6%. Bonds were up 6%. Cash returned 6%. So everything basically is between 5 and 6%, but inflation was 7.
Right.
So there you go.
It was awful. I think what I take from this, and when I talk to others, because there are some stories out there saying we're in a similar period to that. I don't think anybody expects interest rates to hit 13% from the Fed. I don't think anyone expects inflation to be as high as it was. I think the Fed has learned a lot of lessons from that period of time. And I think as we've talked about it, I'm not sure that we can get to even the 7 rate hikes that the Fed was initially projecting when they started this year.
I mean, we'll see, dude. I think already we're living something that no one exactly expected. And depending on how long this Russia-Ukraine thing goes, certain pieces are going to get continually inflated because food prices and oil prices are still going to have pressure. If you talk about pure core inflation, so removing the super volatile stuff that impacts everybody, then maybe. It's also super important to remember they changed the way they report CPI after 1975. So the way that we account for home pricing for the increase in home values is now OER, using owner's equivalent rent instead of just prices. So that's also going to make it more challenging to look exactly like that. But I hear you. Okay. So yeah, hopefully we're not there. If we are, again, the boring answer is you probably don't have all of your money invested in the S&P 500.
Right. Or you just have a long enough hurdle that you can wait for it to come back, because it did bounce back quite quickly as soon as they started lowering interest rates.
Yeah, exactly. And we have plenty of people asking us that who have shorter time horizons because perhaps life expectancy becomes more of a consideration.
But and again, then they wouldn't have all their money in the S&P if that was one of their concerns. But,
exactly.
so talk to us about where the positive in all this could be in terms of rising interest rates.
Well, look, the positive in rising interest rates is what you just said. That's it. If you get higher rates, that means your cash is going to earn more over time. When the hell you're going to see savings accounts pay you 2%, I wouldn't hold your breath. I think my Ally Bank just went up to 0.65% in the last couple of weeks or whatever it is. What's just impactful to look at, and we were talking about this, and this is, you basically made me change my chart because I said it was over 1,000% increase in the 2-year treasury in the last year. And you said, no way. And I said, hold my beer, right? So here's the chart showing the purple line, 2-year treasury. So year over year, last 12 months, it's up 1,800% from a low of 0.14 to a high of 2.78. So an absolute just crazy moonshot of an interest rate increase. The other two rates that we're looking at here, the orange line is the 10-year treasury, which is up almost 90% in the last 12 months from 1.1%, just shy of basically 1.2% was the low in that period of time, to a high of 3.1%. I think right now it's hovering at 3. And then the last one, which obviously everyone's feeling it right now, especially, is the 30-year mortgage. That is up 73%, 72% in the last 12 months from a low of 2.7 to a high of 5.3, 2.7. If you locked in a mortgage at 2.7%, take a photo, frame it, put it on a wall.
Well, we both refinanced close to those rates, I believe. We probably didn't get quite that low, but
I think, brother, I think I have a 3 handle though. I think I have like a 3.2, maybe I'm a 2.9. I don't know. But well, 30-year money, Brett, 30-year money.
My first takeaway from looking at these charts is when someone would say, well, why did this happen, right? What caused rates to go up so much? Because the Fed has only raised rates, we were saying, 2 times, right? A 1/4 point and a 0.5 basis point. So why did rates go up so much? Because the market expects that the rates will continue to go up. So I know there's always this disconnect when I talk to clients about saying, well, rates haven't gone up yet. Well, it depends on what we're talking about, because lots of rates have gone up in anticipation of the Fed raising interest rates.
Exactly. It happens. The rates go up before the hikes happen. And there's charts through time that show you this. Just like the markets fall before the bad economic news is there, right? Same idea, because the market's forward looking. So the question always is, how much is priced in?
Right.
This is an interesting headline from the most recent 0.5 basis point hike, the 0.5% hike. So Wednesday's rate hike will push the Federal Reserve's rate to a range of 0.75 to 1%. And current market pricing has a rate rising to 2.75 to 3% by year end. So that's the expectation. At the end of the year, we're at 2.7 to 3. Okay. What happened in the market that day? Stocks leaped higher following the announcement, while Treasury yields backed off their earlier highs. Wait a second. Stocks went up and yields went down, and the Fed hiked by 0.5%. That's your point, right? That's it in action. Yeah.
They've been so transparent in what they're doing. So I think we also be clear on one other thing, which is there are still rates that are affected by this. Anything that's tied to the Fed funds rate, it's margin rates, or in some cases, really short-term stuff, even your cash is going to be somewhat tied to what's happening. But anything long-term, 10-year rates that apply to mortgages, credit cards and other things, may be less impacted because they're already kind of priced in at the moment.
Yeah, 100%. And look, what's interesting, not to cite technical indicators, because I always feel like that's kind of like looking at the tea leaves for market people. But there are some indicators that people look at to basically peg where the value of the 10-year treasury should be an example of that is the gold copper ratio, the price of gold divided by the price of copper. I know it sounds ridiculous, but historically they follow each other. They're right in line. And from about 09, 10, something like that, maybe a little bit later, so call it between 10 and 12, 2010, 2012, there was a gapping away of that relationship where the copper gold continued up here and the 10-year treasury fell down. And right now at this pricing at the 2.931, so 2.9%, 3% 10-year, it has now gone back to being in line with that gold copper ratio. And there's high yield treasury spread stuff that you can look at that kind of say, based on what we're seeing and valuations as they are and earnings where they are and prices where they are, this is a fairly valued 10-year treasury, which means, yes, we could see a Fed funds rate of 2.75 or 3% at the end of the year. And the 10-year may not be any higher.
Right. I think expectations are that inflation will slowly come down. We saw it this last month. Hopefully it's part of a trend that it comes down month after month. We would hope that probably unemployment goes up a little bit, not hope on that, but it probably does happen as a side effect. We hope that the country stays out of recession, or if it is one, it's very, very mild. And that with all these things going into play, that you do have a higher rate at the end, and when clients look at their bond portfolio and they say, my gosh, it's down. I mean, I think it started the year down, worst part in 50.
Covered so much. Yeah, exactly.
And so you're saying, yes, you've already got the losses, all those interest rate hikes, even though the Fed hasn't done it yet, they're already in your bond losses. That's why you have those losses. So going forward, you shouldn't have any more losses in the bonds. In fact, they should only go up because you're getting yield and yield and yield month after month.
Yeah, I know. That's it. We find ourselves in a similar position as a few years ago where bad news is good news, because if the big risk in the room is inflation, well, that means slowing economic movement, growth is going to be good for that talking point,
right? Because
the Fed will have to hit the brakes a little bit more softly.
Right. I make the analogy that it's similar to if you ever had to go to the hospital for something, you hurt yourself and you have a foot stepped on a nail or whatever, the healthier you go into the hospital, the faster you come out of the hospital. And so I'm hoping that, this patient is the U.S. economy. If the patient is the
nice
U.S.
Are you
consumer.
saying I should stop eating McDonald's? What do you say? Are you coming at me right now? Oh my gosh.
This has nothing to do with McDonald's. This has to do with the fact that if the consumer, if the person in the economy, is got a job and has income and is maybe going through a little bit of their savings to actually spend money on stuff, but hopefully those prices come down for gas and food. If there is a recession, we're hoping it's just a mild one, that we can come out a lot faster, and it's not going to be as deep as something in the 70s or 2008, 2009, where everybody owned 4 houses that were all underwater.
Amen. Did I say good news is bad news? Well, I guess it is. Bad news is also good news, because then inflation comes down.
Yeah, it's a perverse way of looking at things, but that's also short term, right? Short
term.
Good.
Services are coming back up. People are going to the movies more. Top Gun absolutely crushed it in the box office. Congrats, Tom.
Good Tom Cruise movie. I think we talked about that last episode.
We did. That's it, man. That's the State of the Union.
All right. Well, let's hope these things work in our favor going forward the next few months, but we'll be talking to people about it.
Thank you, BH. See you.
Bye.